Hello CFA candidates. Here with some more pricing and valuation of derivatives. We are looking at the world of fixed income securities which pay coupons. If you remember the equity forward segment, you will see the logic is the same. Please remember that any cash flow, this case, coupons, will offset the cost of carry and therefore reduce the futures price. So let's get that pricing done pretty quickly. Looks like this. Take the spot price S0, knock out the present value of the coupons which you will miss out on. And then grow it at the risk-free rate until maturity. Alternatively, and mathematically equivalent, is to grow the spot price S0 at the risk-free rate until maturity, then, minus the future value of coupons. Now just try and bear that one in mind, cause that will be helpful when we get to pricing bond futures when we have a cheapest to deliver option and a clean versus full price issue. So hold that one in mind. But understand, as with equities, those two are mathematically equivalent. Let us put it into practice. Calculate the price of 200 days forward contract of a 7% US Treasury, with a face value of $100, and the spot price is $105. Remember that US Treasury pays always semi-annual coupons, unless we are told the other way. So, during the period of 200 days, there is one payment of coupon due in 182 days, which is 7% multiply the face value of $100, then divided by 2. Now we have a coupon of 3.5. The next step is to calculate the present value of the coupon, by discount it at risk-free rate of 5%. Put that through your calculator, tells us the PV of that coupon, that is, $3.42. So to price, we'll need to take spot price minus that present value of the coupon, then, grown at the risk-free rate for the 200 days to maturity. And it will look like this. Spot is 105, knock off the 3.42. Take that answer and grow it at the 5% for the 200 days to maturity and you should get 104.34. We have priced a forward contract on fixed income. Next, the valuation, which I think is fairly straightforward. So after 100 days. What does that mean? Well, initially we signed up to a 200-day contract. And there was a coupon due, I think, in 182 days. We all now 100 days later. Well, that means the coupon is still ahead of us, but it's now due in only 82 days. So at initiation, we were told there was 182 days till the coupon. If we've moved forward in time 100 days, there are only 82 days until that coupon is due. So if I want to get the present value of the coupon, I'll be discounting by 82 days. In terms of maturity, the contract, while it was 200 days in, there are only 100 days left. So when I'm discounting the forward price, I'll be discounting it by 100 days. Let's do it. The present value of the coupon, which is 3.5 discounted at risk-free of 5% by 82 days, then we got 3.46. Next step. The present value of forward price, which we calculated in the previous example. That is, 104.34 discounted at risk-free rate of 5% by 100 days, we got 102.95. Now we have all pieces. The value of long position would be like this. Take the spot price of 109, knock off the present value of the coupon that we are going to miss, then the present value of the forward price. We are left with 2.58, the value of the long position. When looking at bond forwards and futures, we'd say they're virtually the same if ignoring a mark-to-market feature. However, there are a couple of twists that make bond futures interesting. First one. Bond futures may allow the shorter delivery option, whereby they can deliver a range of different bonds. So although there is one specific bond quoted in the futures contract, there is a range of bonds that the short can deliver. Idea behind this is to give people options. So that isn't a short squeeze on just one particular bond in the market, when all these contracts become due. Secondly, we need to think about quoted bond prices or clean bond prices do not include accrued interest, whereas full price does. So if we're going to quote a price clean, which your bond futures price typically will be, we're going to have to make sure we take out any accrued interest. Now, calculating that accrued interest is fairly straightforward. All you'll do is work out how far through the coupon period we are, and what that coupon amount is. So let's say it's a $10 coupon for the period, and we're halfway through, that is $5 has accrued. Remember, that is as an extra stage to our calculation of our bond prices and values. Once you have the accrued interest, well, your full price is the clean plus accrued interest. Or alternatively, your clean is the full minus that accrued interest. So two issues to think about. The cheapest to deliver and accrued interest. So how do we adjust our formulas to account for this? Well, first of all, think about the short delivery option. All these bonds that you're allowed to deliver for this specific futures contract might have a higher or a lower coupon rate than the bond specified in the contract. So each bond is assigned a conversion factor. That conversion factor adjusts the payment for delivery. So there's a range we can pick with different coupons, but you must adjust them so they look the same as the bond in the contract. When we're looking for the quoted futures price, all we do is take our formula, and this is our absolute standard formula. Admittedly, there's some accrued interest to deal with, but apart from that, our absolutely standard formula for the price, and adjusting it by multiplying by 1 over the conversion factor. Here is our formula. Well, back to our first slide. When we said for a bond forward contract, if we're trying to price it, what we're going to do is take AS0, knock off the present value of coupons, and then grow it. But remember, what we said we could do mathematically equivalent is to multiply by 1 plus risk-free rate and then knock out the future value of coupons. That's mathematically equivalent. So that we've seen already. The good news, this formula is almost identical. There is S0. But it needs to be the full price. So it must include accrued interest. That's a twist. They could throw at you. Here's the spot, but it's quoted. Here's the accrued interest to stab them together. We grow it at the risk-free rate. And we knock off the future value of coupons. However, clearly there is one extra piece. At maturity, we must knock out the value of the accrued interest at that date. So if the maturity date is anytime within a coupon period, we must knock out how much of that coupon has accrued at the maturity date. So yes, it's an extra twist, but it's a simple calculation. Let us have a look at an example. Calculate the quoted futures price for a 1.7-year T-bond futures contract. So there's your maturity, 1.7 years. The cheapest to deliver bond is a 10% T-bond with 5 years remaining. And a quoted price of $110 with a conversion factor of 1.15. No accrued interest as the bond just paid a coupon. So remember, it's going to look like this. We need the full price, we said. Then we're going to grow that full price at the risk-free rate. Then going to knock off accrued interest at maturity and the future value of coupons. We're going to multiply it once we've got all of that by 1 over the conversion factor. We have to calculate the future value of the coupon. So, first of all, we need to draw a timeline. So we sign up obviously at time 0. It is a 1.7-year contract. We have just paid a coupon. Well, if we've just paid a coupon and this is a classic T-bond, that means there are always semi-annual payments. So there are in total 3 payments until the maturity. The first payment of coupon would happen at the middle of a year. Then, taking it forward to get the future value, that is, grow it at 5% of risk-free rate by 1-2 years until maturity. We will repeat the same procedure for the other 2 coupons, growing them at risk-free rate for periods of 0.7 and 0.2 years, respectively. Then, we have the total of future value of all 3 coupons, which is $15.50. Now, we are told that we have a quoted price of $110, we need a full price. So shall we be concerned? Don't be. There is currently no accrued interest. We've just paid a coupon. If there is no accrued interest, then the full price is the quoted price. We have also risk-free rate, which is 5%. The accrued interest on the bond at maturity is $2. So we know the full price, the risk-free rate, the conversion factor, the accrued interest at maturity, and the future value of coupon that we just calculated. Here we go. Full price grown at the risk-free rate for 1.7 years. Knock off the accrued interest of $2. Knock off the future value, the coupon, and adjusted by the conversion factor. Then we have our quoted future price, which is $88.7. Thank you for watching. Please subscribe my channel.